Hey there, business owners. Are you ready to clear up some confusion around accounts payable and COGS? Let's break it down nice and simple. First up, accounts payable. This is the money your business owes to suppliers or vendors for purchases made on credit. Imagine you buy office supplies worth $500 on credit. This $500 is recorded as accounts payable. You'll pay this amount to the supplier later. It's a liability on your balance sheet because it's money you owe. Now let's switch gears to cost of goods sold, or COGS. COGS represents the direct costs incurred to produce or purchase the goods your business sells. For example, if you're a retailer and you buy products for $5,000, this amount is recorded as COGS when you sell those products. It's an expense on your income statement and directly impacts your gross profit. So why does this matter? Understanding the difference between accounts payable and COGS can help you better manage your cash flow and financial health. Accounts payable affects your liabilities, while COGS impacts your profitability. When you're reviewing your financials, keeping these two separate can give you a clearer picture of where your money is going and how well your business is performing. All right, business owners, that's your quick guide on accounts payable versus COGS. Keep these definitions and examples in mind, and you'll be navigating your financials like a pro in no time. If you found this video helpful, give it a thumbs up and don't forget to subscribe for more business tips. Thanks for watching. See you next time.